In a single month, a massive pillar of the global financial system simply vanished. We witnessed a $138.4 billion sell-off in US Treasuries. This chart breaks down the source of that March 2026 exit. The heavyweights are leaving, with Japan offloading $47.7 billion and China dropping $41 billion. The liquidation spread rapidly. Taiwan sold $12.7 billion, Saudi Arabia $10.8 billion, and India $7.6 billion in a synchronized withdrawal. To understand why these long-term holders are stepping back, we have to look at the primary currency those treasuries are denominated in. Over the last few years, the dollar has faced a sustained decline in value. We can track that decline through the US dollar index, or DXY, which measures the dollar against a basket of 6 major foreign currencies. From an October 2022 peak of 113 points, the index plummeted to 99. The American financial system requires a constant stream of foreign buyers to fund the government. With the largest sovereign buyers in the world walking away, the system should be buckling. Yet, it isn't. A new class of buyers is stepping in to fill the gap. The Treasury Department and lawmakers anticipated this foreign exit. To keep the debt markets functioning, they engineered a mechanism to generate a brand new class of captive buyers. In July 2025, that strategy was codified into law through the Genius Act. Signed by President Donald Trump, the legislation was drafted to maintain the dollar's position by modernizing how it moves across global networks. The act focuses on stablecoins, digital assets designed to hold a steady one-to-one value with the US dollar. The Genius Act established federal oversight, requiring complete transparency and strict reserve requirements for these tokens. This tokenized the dollar. While traditional banking systems pause for weekends and operate slowly across borders, blockchain networks run 24/7, allowing instant global settlements. The reserve mandate is the most important part. By requiring stablecoin issuers to back every token with real dollars or equivalents, these private technology companies are now legally required to purchase massive amounts of government debt. It functions as a strategic pivot. The government built a digital ecosystem that swaps out unpredictable foreign buyers for domestic, highly regulated technology companies. Once the regulatory guardrails were in place, institutional capital moved into stablecoins, accelerating the transition. This area chart shows the impact of the new legislation. Since the Genius Act passed in mid-2025, the total stablecoin market capitalization surged from $260 billion to $322 billion. Because of the reserve requirements, that capital must be parked in safe, dollar-denominated assets. This means a handful of corporate entities are now absorbing the debt that foreign nations discarded. Tether is the clearest example. By December 2025, Tether held $122.3 billion in US Treasury bills, larger than many sovereign nations. Circle, the issuer of USDC, added to this demand by holding $20.9 billion in Treasury securities by March 2026. That $138 billion hole left by foreign powers has been caught by blockchain entities. These companies are now functioning as a pressure valve, absorbing debt that used to be held by sovereign central banks. The exit from the dollar is unfolding along geopolitical lines. While some nations pull back, a coalition of Western allies remains deeply committed to the Treasury market. In March 2026, while billions were being liquidated elsewhere, the United Kingdom was actively buying, adding $29.6 billion to its Treasury holdings. We saw similar patterns with the Cayman Islands adding $16.4 billion, and Germany picking up an additional $3.7 billion in debt. These economies stay because the alternatives are not yet viable. Competing fiat currencies remain too fragile and illiquid to support the daily volume of global trade. The global financial system is bifurcating. We are entering a two-tier structure, where traditional allies stick to standard banking, while the slack left by exiting adversaries is caught by a digitized dollar ecosystem. For anyone trying to protect their wealth, this changing of the guard requires a shift in focus. The actions of foreign central banks are no longer the only metric to watch. You now have to monitor crypto regulatory developments with the same level of scrutiny. The enforcement of the Genius Act and the resulting demand for stablecoin reserves have become real-time indicators of macroeconomic health. The United States is using blockchain architecture to maintain its position at the top of the financial pyramid. Navigating the next decade of finance requires following these regulatory shifts as they happen. Let me know in the comments, do you think stablecoins can permanently stabilize the debt? Hit the like button, subscribe for more breakdowns, and I'll see you in the next one.